Well, hi everyone, and welcome to the Buffett and Beyond Research Saturday Market Recap Letter, and this is February 17th, 2024. The month is more than half over already. Remember, folks, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And this week, the market broke through the 5,000 barrier from both above and below because it went above the 5,000 barrier, and I'm talking about the S&P 500 for the first time ever, and then we had a dramatic decline of almost 100 S&P 500 points at one point during the day, and then it bounced back up above that 5,000, and now it's just meandering around. Now, the market had to deal with slower declining inflation, slower consumer demand, and higher wholesale prices. Whoops, going the wrong way in all those areas. Now, it's near the end of earnings season, and Nvidia reports on Wednesday. And usually near the end of earnings season or at the end of earnings season, the market just kind of meanders around and waits for news or to justify the next move on the entire market. And with Nvidia, boy, oh boy, it's one of the largest companies in the world right now through market cap, and that's price times the number of shares outstanding. And folks, it's a hot number, and maybe the market is expecting too much from this stock. I mean, it's up over 200% for the year already. So we'll see what happens this coming week. Now, our weekly stock analysis video, Paulo Alto is in the cybersecurity business, and folks, we must have cybersecurity, and business must be good. Why do I say this? Because the stock is up over 100% the past year and up over 400% over the past 5 years. Now, our ETF video, the top stocks in our top 4 ETFs are not only beating their own ETFs, but also the S&P 500. And guess what? The hedged portfolios, hedged 100%, are even beating the S&P. Very little risk there. We kind of like that. Now, we've been talking about the triple inverse ETF, which is the SQQQ. Now, the QQQs represent the NASDAQ 100 stocks, the largest companies, minus any financial stocks. The SQQQ is a triple inverse ETF, which means that as the QQQs move, the SQQQs move in the opposite direction by 3 times. Now, there's a lot of misunderstanding regarding the SQQQs because they are really designed to mimic the inverse, and by triple, but they're designed to mimic the inverse of the QQQs on a daily basis, not over the long term, because they're made up of futures, they're made up of treasuries, they're made up of options, and the people who run them use various instruments to have the inverse or to try to mimic the inverse of the QQQs. Now, our portfolios have a lot of tech stocks, and when we design our portfolios, we don't design them exactly to be the QQQs. So therefore, when we try to hedge one of our portfolios, we don't have an exact hedge. So in other words, if the portfolio moves down 10%, will the triple inverse ETFs move up 30% exactly? And the answer is no, because they don't move, or they don't have 100% correlation. Let's put it in that respect. So the SQQs are not 100% correlated inversely to the QQQs. And that's what we have to deal with. But we can hedge both our 30 stock growth portfolio and our ETF portfolios too, using an approximation. If the market goes down, these triple inverse ETFs will go up. Not by the exact amount that the market goes down, and not exactly triple the market, but they will move opposite to the market. And so that's what we try to do. We don't try to mimic dollar for dollar declines. We don't try to mimic even close to dollar declines. So the SQQQ is not an exact hedge. That is designed for the inverse movement of the QQQs one day at a time. I'm reading number 3 here. Thus, over time, it may move more or less than the triple inverse of the QQQs. And so we deal with it. Now, we hedge so we can reduce the loss in our portfolios during severe market declines. We also hedge so that we may cash in our hedges from time to time. And folks, this is so important, especially as you go longer term, because when we get one of those 10 or 15 or 20% corrections, those SQQs will go up in value because they're the inverse of the declining market. And when we feel we're near the bottom, don't have to get it exactly, but when we feel we're near the bottom, we will cash in those SQQs and buy more shares of the portfolio that we're in, or buy more of a stock that we've been looking at to adding to those portfolios. This way, over time, you continue to build up the number of shares in your portfolio because you're using these inverse ETFs. So that's really the key that we want. We want something that makes money when the market goes down, and then we want to cash it in and buy more shares, because if the market goes down, that means the shares in our portfolio have gone down and they are cheaper than they were the day before or the month before or the year before. That's why we use the SQQQs, because they are the most popular inverse ETF out there, and therefore there's good liquidity in that SQQ. Again, bottom line, no, they're not an exact hedge, weren't meant to be, but we can use them to our advantage. Okay, let's get to the market. Well, here we are, riding the top of that volatility band, and then was on last Tuesday we had that serious decline, tested that, and we talked about the 20-day moving average right in here, and we talked about a reversion to the mean because it happens all the time. Look over here, look over here, look over here. So we expect it to happen. We didn't expect it to happen in one day, but it happened in one day. And then all of a sudden the market went up, and notice the 5,000 level over here that we talked about. So the market closed above the 5,000 level over here, then fell down below it, and then closed above it a couple of days later. So right now the market is just kind of playing around, really sort of waiting for Nvidia to report its earnings on Wednesday. Earnings season is over. The market may meander around, but it will be looking at Nvidia, which to me and everybody else is priced to perfection. So we'll see what it comes up with. And when we look at our intermediate term indicator, well, that's about as flat as you can get. So is this indicator telling us anything? Nope. Not a thing. It's not telling us the market's going to go down. It's not telling us the market's going to go up. It's just sitting there, but it is overbought. Or it's in overbought territory. And when you look at this histogram, we don't talk about that very much down here. You can see it's very, very light in here, and that means the market has no direction right now, trying to stay above that 5,000 level up here. Now, let us look at the S&P 500. And what has us worried, now I'm recording this just before the market closes, about an hour before the market closes, and the market is almost unchanged in here. But if it goes down, and remember, Monday is a holiday, if it goes down on Tuesday, it will form a bearish divergence, short term again, I should say. And here's that 20-day moving average. It might go back down to test that again. And so we'll just have to wait and see. Blue line's 50-day moving average. Red line is the 200-day moving average. We do not expect this market to come all the way down here by any means. And here's the flat line again, once again, on the intermediate term indicator. Let's look at the QQQs. Well, the QQQs were down as I'm recording this. It doesn't mean it's going to close down in an hour or so, but we have a 3-day weekend coming up, and we're letting everybody go a little bit early. And this QQQs, the NASDAQ 100 stocks, are really flirting with that 20-day exponential moving average. Our problem is down here, it looks like it has turned down, doesn't it? Yeah, so that's a little sell signal, and with this divergence up here, if it stays down or closes down on Tuesday, we'll get a little bearish, short-term bearish divergence, and that means we're going to test this 20-day moving average and then maybe even test the 50-day moving average down here. But we'll see. We'll see. And portfolio protection, well, today, the February 16th SPY 410 put expires, and we went out to May 17th, and notice we're going up. As the market goes higher, we will raise this put. So instead of buying the 410 puts from May, we are buying the 425 puts. We want to stay 12.5% to 15% below the market for disaster insurance. So, folks, that's what we do. The February 16th put expired, and we are buying the May 17th, and we sent that out in our daily letter today. So, folks, we had a tough week. The market was below the 5,000 level, went above the 5,000 level, closed below the 5,000 level, and now is sitting above it as we speak. So, it's the weekend. 3-day holiday. Go out, enjoy yourself, folks. Have a good time. Stay safe, and we'll see you back here on Tuesday.